Welcome, everyone. Thank you for attending our session today. It is titled Crypto FinTech Systems, Can the Ultimate Trust Machine Be Trusted? And we have two speakers today. The first is Bobby Singh, CISO and CTO of Toronto Stock Exchange. And our second speaker is Miroslav Kish, Director of Technology and Cybersecurity at TMX Group, Inc. Please help me in welcoming our speakers to the stage. Thank you.
Come on, man. Well, good afternoon, everyone. You know, we were just debating, standing there, wondering why the room is not full, and we realized this probably has to do with the fact that the Bitcoin is not as high today as it was last year. So, and because of that, we're on your way out, you all get some crypto. So, I'm glad you're here. Anyway, we'll kick this off a bit. So, I run the technology and cyber for the Toronto Stock Exchange in Toronto, if you're wondering where it is. One of the things I think we're going to share today is what is our journey has been when it comes to crypto. That doesn't mean we implemented it. We just had the opportunity to kick some tires on a bunch of the blockchain, using some of the blockchain. So I want to give you a context of our organization, so give you a bit more understanding of who we are, so as we go through the next few minutes. As we're probably the largest trading venue in Canada, but also we also have a clearinghouse equivalent to DTCC. So it actually gives us a fairly good view from a value chain perspective from start to finish on the whole trading environment, and that gives us a chance to also kick the tires, as I said, on the blockchain kind of DLT technology. So that was really one of the key things that we were privileged to work with over the last few years. As you will hear from Miroslav later on, we had the opportunity also to write a bunch of white papers on blockchain and the use of blockchain in the financial sector, such as the DLT stuff, as I mentioned earlier. So we'll get into those details later as well, but if you're interested in the white paper that was written a few years ago, you can come and Google us or let us know if you want to read the white paper. The other thing I was just going to mention, I tend to use blockchain and DLT interchangeably, so just keep that in mind, just bad habit in that way. But other than that, I think we'll just get into the right thick of things. So let's talk a bit about what is DeFi, and is DeFi here to stay, or is it going to change how the traditional FIs work today? So that was really one of the key things we wanted to talk about is the DeFi as a way moving forward, or is it just a fad? So over the last many years, as I mentioned earlier, when you look at the promises the blockchain has made, and we're going to try to decipher a bunch of them today, has it lived up to its value proposition or not? And I think that's really the crux of the matters in the discussion we're going to have is where is blockchain today? And is there a convergence that's about to happen between the traditional FIs and the DeFis of the world, or sorry, on the blockchain side? Second bullet on the promises that the two parties can interact without a middle person. Still, it worked it out. I don't think that's necessarily true in the blockchain model. Somebody's got to still develop it, so we have coders. Somebody's got to still mine it, so we have miners from that point of view. So thinking the fact that it's a totally algo-driven technology, I don't think that's a bit of a naiveness. So we try to decipher that, as well as what the role of the miners, how the miners can even collude for that matter, what kind of things miners can do actually to dodge, make blockchain not live up to its promises and all that. So that's the other part. And the fundamental answer we can also answer it from a DeFi point of view, the trusted model. Can it be trusted or not? So we'll get into a bit more details on that as well. And last but not least, the future of financial system. As I briefly alluded, we think there's a value on the convergent piece. So we'll get into details about where the convergence can actually occur. And we'll walk through a couple of examples that we actually put together on what we have done in the past on looking at some of the crypto models or convergence model where both systems can live in harmony. Oh, the other thing I was going to say, by the way, if you have questions, we'd love to keep the session interactive, so just feel free to ask, please. Use the mics. I think there's a mic up here. If you don't mind, if you just want to raise your hand, that's fine as well in the yellow way. But love to get your thoughts on if you're dabbling into blockchain, done some of the prototypes or whatnot. Love to hear your thoughts on it as well, because there's no way, shape, or form two of us have solved the problem yet. Otherwise, we wouldn't be standing here. So anyway, having said that, in all honesty, just share your ideas and thoughts you have on how you've done it. So on the side of just looking at as I said, the future piece of it. Oops, sorry, didn't go up. Oh, here we go. So Let's talk a bit about, this is one example I like to use on how we think the both system can live in harmony, and then like I said earlier, we'll get into a bunch of the challenges as well. Here you have on the left a user that's basically wants to buy crypto, right? You and I, for example, buy crypto as a matter of fact. But the biggest difference here is you're not going to something like Coinbase or anything. What we're doing is we're actually dealing directly with a traditional exchange, such as the NYSEs or the NASDAQs of the world, or the Toronto Stock Exchange if you happen to be in Canada. So that's the intent of the model is. You have a traditional environment where the governance and oversight is already there. Keep in mind, if you look at some of the use cases in the past or some of the challenges we had with the blockchain, what strictly has to do with the fact in certain cases, some of them has to do with key management, but certain cases it was all about not having the proper governance and oversight, and that blew up to it. People lost millions of dollars. In this example, what you have is your traditional exchange. Some can debate if they're stable or not, but I think overall I would say they've been pretty stable over the last many decades, and the fact that they're certainly more stable than your typical crypto exchanges. And the idea is that you are buying a token of a crypto. So at the end of the day, if you buy shares of IBM, for example, or Cisco, whatever else, you just get a statement saying you own 1,000 shares of Cisco. All you're going to get in this case is a bit of a line item on your statement to say you have bought a 1 Bitcoin. Let's just say that happens to be the case in this example. And then you have the liquidity provider on the right side, which is trying to make sure during the clearing aspect of it that the exchange is clearing on this crypto exchange. And in the middle is you have a crypto exchange, which is basically keeping a ledger, right? To say at the end of the day, person A has this many Bitcoin and person B has so many Bitcoins. But key difference here is you're not owning the keys. So let me be clear, you have no wallet in this scenario. And that's the biggest difference is, so you're trusting someone to maintain your wallet, you're trusting someone to manage your crypto on your behalf. And the keys are only for the exchange itself. So the exchange does need a key at the end of the day to write to the crypto. How often you write to the crypto, to the blockchain, it really would depend on the business model. You can write it every hour, you can write it into the day, whatever the business model happens to be. So we're not getting into debate about how many times does it need to be written on the blockchain. But the idea is that you, as an exchange is writing on crypto, on the blockchain. But more importantly, they're the one that has the wallet and has the keys to manage. And we'll get into some of the discussions regarding how to protect your keys and so forth. But that's the whole gist of it. So the whole convergence piece I was just briefly alluding to the fact there's a way to have both of them live in harmony. The other part I think which is not depicted here is eco-friendliness, right? So given you're not writing to the blockchain all the time, you're not burning that much energy and so forth. So the whole idea is if the exchange is doing it at the end of the day, it's not writing it all the time and so forth, then it has cost savings as well as environmentally friendly, I guess if you want to call it that way. Any questions? All right. So like any other model, if you look at it, there's always going to be a challenge. These are some of the issues or risks that we actually highlighted on how to, in this model, what some of the challenges are. Nothing should stick out. It's fairly typical challenges in any business operation model that where cyber is playing a role. Access control. We're all heard of access control issues. We know there's the insider threats and so forth as well. So we try to depict where the insider threats can occur in that model. Key management. So key management, we'll get into further slides on how to protect the keys. But as I say, Achilles heel of the encryption world, period. Even before crypto, key management was always the biggest challenge. So we'll get into some of the details regarding that. Disaster recovery. How do you recover if there's an issue from recover your keys for that matter, using HSM and so forth. So we'll talk a bit about that later on as well. And we'll get into also the validation and smart contracts. Is there value in blockchain related to smart contracts? I think there is. I think I've seen blockchain work really well in a permissioned private environment. Not sure too much about the public one. The verdict is still out, but definitely in a permissioned environment, I think the blockchain works really well. We'll get into a couple of use cases there and so forth. Yes, sir.
How does that work out with FTX?
On the
We were talking about where you don't have your own, everybody, you don't have your own keys, and FTX has all keys. So you could really have your own blockchain, you're on blockchain, you can use an FTE to access it.
So that is exactly what the problem was, because the guy who owned FTX had all the keys, and he was sitting. That's the de facto model. If you go to the previous slide, yeah, that is the de facto model that exists. While we had the dream about nobody is in between, eventually it looks like economists call it that disintermediation and followed by reintermediation, meaning you get new intermediaries that are probably more efficient in some ways, but sometimes not that trusted. But that's a whole story about that. Absolutely.
And I think that's probably the biggest reason behind it, right? You're right. The model is kind of similar to FTX, but lack of governance and oversight it was probably the biggest issue, and the regs. Yeah.
All people living in a house, all doing stuff. Did that go wrong?
Yeah. Anyway, so just a couple of comments on the key management piece, as I said earlier. Multi-factor authentication, certainly we've all heard of it, but some of the things we're recommending and some of the things we use in our prototypes were, beside the MFA, changing policy, for example. It shouldn't be easy to implement any kind of key management policies. It should have multi-approval process in place, and also implementing time locks as well. So we'll get into time locks if you want to hear more about it, but that's really one of the cool things we want to have in place. The mitigation 2, hardware security modules, split keys, split authorization and approval goes without saying. Anywhere between 3 to 5 people, for example, should have, your master key, for example, should be split into that many different modules across the HSM, and dual set of controls. We also think the hot and cold wallets, for example, the hot wallet should be used for your day-to-day transactions once you know what your business operations look like, and if you are only transactioning or trading, for example, 100 or 200 Bitcoins, that should be in the hot wallet, but the rest of the stuff, for example, should be on a cold wallet, right? Cold wallet storage is certainly offline, so you want to make sure that where your bulk of the assets are, and the hot wallet is basically what you use for your day-to-day transactions for that purpose. Okay, I'll pass it on to Miroslav just to walk through the rest of it.
Okay, so we come to the point about smart contracts. Turns out that they are not necessarily contracts in any legal sense of that word, and not, as you will see, not terribly smart at all. But what is the issue? Actually, it's an interesting idea. It is de facto rule-based expert system on blockchain that is executed when application function that is executed when certain conditions are met. And we have that in ATM machine. You go there and you type your PIN, you ask how much money, and you get money from ATM machine. So it's not really something new. However, the issue here is we are putting that on a blockchain, and then you will see that goes to approval of those validators, and it's becoming complicated. And we also, if you go to some real life situation, then you get complex rules. And we know that from rule-based expert systems that were very popular probably 30, 40 years ago, where we thought that we can explicitly set rules for everything. Turns out you have 200 rules, and then the rules start conflicting each other, or you don't have sufficient number of rules that are not covering everything, and then system gets confused. On top of that, what we have as a problem is readability now. If we take that as a contract and you go to get your mortgage for your house, for example, from that contract, then you have to know how to read it. And it's written in a script language that might not be that easy to read and understand. On top of that, even if you understand that, we know from application security, when we read code, we don't see everything. We have whole sorts of DAS, SAS tools that are trying to figure out how the application is going to work. So you have a problem with readability, but also with the rules that might be not that well defined in terms of code, that might be buggy, and you might have a problem in execution. And they had that on Ethereum, probably Ethereum fork, if you remember. It was a major embarrassment probably some 10 years ago roughly, because guy figured out that he can get some $50 million from that budget that group collected. And then turns out that these guys that were organizing whole thing said, oh, that's not that's against our rules, but he said this is really how your program works. So I didn't do anything wrong, I didn't hack it, I just executed in a way that you didn't expect. So then they turned that whole thing, that they created new blockchain, new fork, and removed that, but still question stays, what is then contract? Is that what is written in code, or is something that has to be still written in paper or interpreting? And then you would need to have lawyers that are qualified to do application code review, test the system, and figure out whether it's going to work that way. So great idea to automate some clear use cases. Should be done, and we do that all the time. As I mentioned, the ATM machine, all the other things that we have automated now. But on the other hand, if we go, I wouldn't give it a contract name, because it's a problem that it's not a generic contract in legal sense, that you still need some people that are more qualified to assess if that's in the spirit of the law, as opposed to how it's written. So modern legal theory, just to finish this sentence, is looking not only how contract is written, but what was behind thinking, and what is the spirit of that, and the judge makes a decision. Here you have guys, I'll talk about that soon, about validators who are making that decision, whether that's a valid decision or not. I don't think there is one single case that would support that idea, and that's I will talk about that, because it is based on that anarcho-liberal idea that you have group of people that are working together, and there, let me go to the next slide, and that might here is, we are coming to that. Your question is really segued to this slide. So we people that invented the blockchain were thinking, okay, you have validators that are going to validate all these transactions. We don't trust the centralized institutions. We hope that all these people that get together are going to make right decision. Majority of them is going to right decision. However, their assumption is so-called homo economicus, meaning that person who is making that decision is strictly interested in enhancing and getting that reward for doing validation properly. So every validator who is the first one to validate properly and create that special hash code is going to get some reward. And that transaction fee that exists, plus tip that people add to that, so that their transaction is processed faster, they are then incentivized to do it properly. What is the problem? First of all, you will have a zillion of people that want to make money. So if it's a trivial transaction, and obviously that works with Bitcoin, if it's going from one account to another, you check whether source account has enough money and whether the other account exists, and you just say, yeah, this looks like a good transaction, that's fine. If you go further, which is ambition to replace existing financial system, then it becomes not that simple. Imagine some derivatives and you have to make a decision whether a certain transaction is correct or not, and you have guy that just downloaded software somewhere from internet that wants to make some money, and he has to say whether it's valid transaction, financial transaction about derivatives or not. Very few people, even in financial world, understand those complex instruments, financial instruments. So that is one insufficient knowledge is one big problem on more sophisticated systems. Then you have satisficing. That's a known issue with us, which we do every day. When we figure out that something, it's also called, I guess, diminishing returns. So after a while, you don't want to go into too many details. If you have to make a decision, it's below certain level of risk. $100, you don't have time to spend on that 2 days figuring out whether that's a good or bad. So then you just say, okay, that looks like a good idea, and you make that call. However, in crypto world, where you are competing against other miners, and you want to be the first one to validate that transaction, then you are incentivized to even guess and say, okay, this is a good transaction, you approve it and see what happens. If it's wrong, you missed it, and if you are late, you missed it for sure. So then you go with that satisfying, meaning checking whether that's fine or not, very little time, as little as possible to do that validation, and then you might make a mistake. Then herd behavior, also known from behavioral economics. People are following those guys that are validators, following somebody who they trust. And then that guy might be somebody who is famous but might not be right. And they are just following because they think that that's a good idea, and since they might not even know enough, they just go following herd leader. So that could cause that some decisions are made totally wrong. Motives. Then we are coming back to Homo economicus. Basic idea is everybody wants to make more money, he wants to do right, or she wants to do right a thing as a miner, and then he is getting the reward, and that's how they work. However, you might have somebody that is going there for political reason. You might have somebody who is going to attack, even never happened to my knowledge, but it's not impossible to imagine. For example, Bitcoin is using enormous amount of energy. So I'm just wondering at what point of time some eco groups are going to attack the system and try to take it down. So their incentive is not to make money, or it could be political reason. If there is a blockchain doing some things that are important, if it's a crypto exchange, for example, somebody might just want to destabilize that whole thing and lose money there for political or some other reasons. And instead of having a stable system, you might have a system that is breaking because of political agenda or other ideas that some people might have. So public blockchain in that sense is a problem, because you don't know who these guys are who are validators. So anybody can join, you can download software, you can do it, and any number of validators, majority, can make a decision. So then that you cannot control. You can do proof of stake, we'll talk about that a little bit more, where you have people that are validating, that are those that have a lot of already coins there. So idea is that if you have a lot of coins in that blockchain, then you might be more interested to keep it working. But then you might have a problem with Elon Musk, who would have most of the bitcoins or most of the blockchain coins, whatever that blockchain is about, and he can make a lot of decisions himself. So private blockchain, but then we are going to something, and we are going to talk about, as Bobby mentioned, convergence. We do have validation already. We have 2 pair of eyes, 4 pair of eyes, or how do I call it, in financial system already. So it's just the same thing. If you have private blockchain and validators that you know and appoint that are trusted, then you do exactly what we do right now in the financial system. We make sure that not one single person can make a decision, and we appoint people that are knowledgeable, sufficient, spend sufficient amount of time on making right decision. So validation consensus types. So here we are coming to that what I mentioned. You can have majority vote. So you have Bitcoin, those guys that are talking, and you submit one transaction, and they are voting. And if you have majority that is saying 51%, that is saying this is a good transaction, transaction is accepted. Problem is you might have a lot of miners, and each miner has to calculate that hash, and that becomes energy consumption is huge, and also you don't know how long to wait until you have that decision. So if you have thousands of them, or even tens of thousands or more, then it takes a while until they come to the decision. So this majority vote is not the best thing, definitely, but that's what it is. That's one of the ways how to get to consensus. And it is interesting enough that all these methods that are invented replicate what we went through since ancient Greece to now in developing democracy, republic, and so on and so on. For example, there was a rule that only people that own some land or house, they can vote. So that's a proof of stake now in the modern blockchain. Ethereum went to that model. Advantage of that model is that you have, if you have sufficient number of coins, you have priority to be elected as a validator. And then you have less validators. You can have still a couple of them together, depends on the algorithm how they set it. But then you might have 5, 7, 10, or whatever they discuss, and the majority of those guys can make a call whether that's good or not. So how is that better? You don't have any more 100,000 people that are competing and wasting energy calculating that magic hash for Bitcoin. You have 10, 15 people that are making decision, and that's much faster. And this is Ethereum went to that probably 6 months ago or something like that. But what is the issue there? It's interesting again. There could be some issues. People are looking at that and then saying, okay, me as an individual, Miroslav, have no chance whatsoever to get on the top of that list, to be elected, to get to validate and get that tip and transaction fee as a reward. So then you have a group of people that are getting together, and they do that staking. They together put their coins, whatever they are, and they have better chance than to be elected as a group to do validation. Also, they then share money, whatever reward they got from validation, and they then that's how it's organized together. Then you have a similar thing is delegate voting. they elect by some method these miners that are going to validate, and they can later remove them, similar to what we do in Parliament. We put some people that we just to make decisions on our behalf. Round robin, you can go around and pick people in a group, from a group on a round robin way, and you can do mixed. So, for example, for staking, you can pick round robin way out of 107 each time for next transaction. So, what is the key point here? Bobby already mentioned. We haven't figured out yet in political system or in this system a great, absolutely correct system that would always come with the best decision and correct decision. So here it's not perfect. So when we say that blockchain is trusted, cannot make a mistake, not really. In Bitcoin world, simple transactions, most of the time everything is fine. But in smaller blockchain implementations of public blockchain, you might not be that lucky. It's not perfect, definitely. So now we are coming to that governance piece. This is a crucial piece. Problem is that a group of anonymous individuals is expected to govern a system without political power that enforces the laws and regulations, as you were pointing out before. So, anarcho-liberal view of that is that you have a group of people together, and then you have reputation of these people, so they wouldn't make anything wrong because they would be expelled from the community, and so on and so on. However, it doesn't work really well with the system that is where people are anonymously joining and can anytime join and go out of that group. So there is no reputation. You are known by your key, public key, and you can just create another one, do something bad, and then turns out you go to another one, or on the same one you create another key and you are a new person as far as the system is concerned. So this is a problem that is political system here of anarcho-liberal doesn't work well, and could work in a small village where everybody knows everyone else, and then they could maybe work that way, but not here. So then operational risk. Again, that group of coders that are preparing blockchain code and running that whole thing, they are still have all the issues that everybody else might have when they are running any operation, any system, technology system that needs to be run. So yes, it's distributed and so on, but still can have bugs. You need to update them, upgrade, and so on, so on. So this is not, and they have to accept those upgrades on majority level, and so on, so on. So they cannot avoid that problem about running the system that we have in any other technology company. Then you have financial risk. So this is a problem that we were talking about. This guy in FTX had a lot of cryptocurrency in his wallet and figured out and said, okay, why wouldn't I make more money? So he started investing in another all sorts of investment that were not controlled in any way. Also, he, as a collateral, would put cryptocurrency from his another company and as a collateral, so when both companies went down, nothing happened. To be fair to him, some 300 years ago, Bank of Amsterdam, famous one, failed that same way. They had initially invested in some good investments in colonies, and they were working for almost 100 years. All over the sudden, they decided to make some more riskier investments, and then there was a run on that Bank of Amsterdam, famous one, and then everything went down, similar to Silicon Valley Bank just lately. So my point here is not there is no perfect system. This is humans. This is their behavior. But still, in this system that we have, a financial system that we have central bank or Feds here in the United States, and they to some extent control who can do what and how much risk they can take. So this is our best bet that we can improve that system. Whether we can do it on a public blockchain, this is really regulate something that is built to be unregulated. So it's a problem because you can run it from somewhere, from a country that is not regulated at all. It's a problem. You can maybe regulate exchanges that we had shown before that are endpoint, but you cannot regulate the entire system easily because it's made not to be regulated by government, and that is a major issue. While, as I said, regulation, internal regulation based on reputation and that group doesn't really work well. So this is how we see convergence. As I said before, we could tokenize in existing financial system, tokenize transactions, digitally sign them, so they are more, it's harder to attack them by virus and something like that, change them, and you would have with our existing financial business process similar, very almost the same process like you would have on a public blockchain, just you have people that are running that operational technology people and also business people running the same process, just with digital tokens that are now very similar to what you have tokens in blockchain, public one. Post-trade processing, many financial organizations are going that way already because it's not time critical, but can be protected well. Integrity is there, very important. In post-trade processing, you have evidence of how many shares you have in a certain company, and that's integrity is there important. If you digitally sign those transactions, that makes them much more secure while achieving the same goal like this blockchain. And as I said, convergence is there. Intermediaries always exist. Let's not fool ourselves. It's at the end of the day, FTX guy was there because people didn't know how to deal with those public-private keys. What the hell that is? Can I buy Bitcoin? They go to him and he says, okay, I keep your Bitcoins for in my wallet. Don't worry about that. And and then it goes that way that it went, unregulated and everything else. So we are not going to avoid intermediaries for other reasons also, because if you want to buy Bitcoin or something, transaction fee was up to $60 at one point of time in 2021. On Ethereum it was $120 one transaction. Then what we do on traditional exchanges, we put several transactions in one, and then you pay only one transaction. So you need intermediary that is going to collect that, broker that is going that for you, and they are doing that in also in crypto DeFi world. So again, closing that whole thing, closing to what we have in centralized financial system. So we could, we should probably look at their model because they don't have our technology systems in financial industry are often following, we are automating piece by piece and then we have a segmented system that is not that efficient like blockchain. What I mean by that? You have a separate exchange, then depository, reconciliation, everything else. If you have digitally signed transaction from the very beginning, you can have straight-through processing much faster, and they do have it there. So we should take a look at that picture and try to figure out how we can improve our business processes in financial industry and get a more efficient system following them while we can provide the trust that FTX and guys that are just coming out of nowhere and promising a lot of things cannot do. So this is how we see that convergence. And this is, we have a paper at IEEE Blockchain Conference 4 years ago about that in more details. So this is what I was talking about. This is, I didn't move to this slide, but this is repeating what I just said. And what do you do? So if you want to go with that blockchain, in either case, whether you are planning to manage crypto assets or tokenize existing systems, start reviewing and strengthening key management process and supporting technology solutions. This is becoming a huge issue. Whatever we do with the key management right now, when you're managing keys for TLS or something like that, that's nobody cares that much about that. Of course, it's. But here, when they have incentive to steal hundreds of thousands of dollars in one attack, you better have all the ducks in a row. They are going to find each and every detail that you missed in your process. So it has to be much more, much better reviewed and strengthened than processes that you have right now. So then take a look at where blockchain and digital signing would make sense for you. Obviously in trading we want to do that faster, and blockchain technology right now is not that fast that we would like have, but depository, as I said, reconciliation, things like that, that could be something. And more than that, if you want to go in this world, if you want to do smart contracts and so on, better get a team of DevOps team that is going to be qualified to run the blockchain, to develop special language, to do code reviews, and keep that whole thing running. This is a crucial piece. If you don't have that nucleus, it's hard. Based on this presentation, you're not going to get too far. You will know the problems, but to operationalize that, you need much more work and a dedicated team. Okay, that would be all that we have for today. There are a lot of other questions, obviously, both on a financial risk and technology risk. But we have 15 minutes, and if you have more questions, please do ask.
Can you go back to the convergence slide? Yeah. Can you just say more about what you see in the future?
So that part, if you want to know, we have a IEEE paper under our names explaining how that be done. So you tokenize your transaction from the very beginning. then you don't have to do later reconciliation, because reconciliation is that you verify that somebody has that whatever you are buying and that it has sufficient money. Everything is immediately when you go into transaction, you already have that tokenization guaranteeing. So you wouldn't go to that what takes T+1, T+2 days now to reconcile and get all the things together. So this is where we see that convergence would go. With the also central banks, that's another topic that I couldn't touch even in 50 minutes. Central bank digital currency. So this is another venue where central bank could go now with digital currency similar to Bitcoin, but just issued by a central bank. So that could be a convergence that would provide trustworthiness of the financial system that we have it right now, while providing that also efficiency or user-friendly, interesting tokenized money. Sorry, can you
Can you repeat that? Sorry, I
I didn't hear.
no.
Can you?
Oh,
give
there's
me
a mic.
the
Sorry, there's a
microphone?
mic there. Still. Oh, yes, sir. Yeah, sorry.
Yeah, if we push to tokenize the current assets, who plays less of a role in the current system?
On tokenization, you mean?
Yeah, in the current financial ecosystem, like the clearers play less of a role.
I think the model I showed earlier, it's the same model, right? The exchange is still playing the role in the from a ledger point of view, who's buying, who's selling, if that's the and they're the one that tokenizing it as well.
I see.
At the end of the day, and the idea is that the exchange will actually, to Miroslav's point, that's a similar concept, but then you're buying a crypto as a tokenized item, but nothing else.
Right, so players don't change, basically.
No, there's no change from
Right,
that.
I see.
Yeah,
Okay.
yeah. And sorry, go back to your question on the conversion piece. The T+2, I'm not sure how many people know about the exchange world today, but you do have 2 days to clear or settle the buying and selling of the assets, either via any trades or fixed assets, for example. The idea is that with the conversion piece, what we're hoping to do is that it actually is done in T+1 or it's done in real time. So that's where the real value of the blockchain comes into the exchange world. Exchange world work today does have 2 days. So if there is a collusion or some type of fraud, if you ever look at your contracts that you sign with Fidelity's of the world or Charles Schwab, you'll say that they have 2 days to reverse the trade if they want to, if they detect fraud. The whole idea is with the blockchain, hopefully, if it's written immutable and so forth, that we can actually do it real time, and then you don't have, you take the 2+2 out of the equation, which helps with the capital markets point of view. You don't have to hold the money for that long. Yes, sir.
See the exchange ledger being stored as a blockchain as well, because if you don't have an immutable record of the exchange, what's the point of having blockchain?
Yeah, no, that's a fair point. Look, as I said earlier, we're still dabbling into it, so we'll see where that goes. But fair point. Look, it's where we.
Eliminate all the need of the right-hand side of the
Yeah, but I think the.
exchange begin with.
Yeah, I think there's a more use of DLT in the blockchain we see on the post-trade side, the clearing piece, more than the exchange side, at least as a starting point. Where the next few years will lead us, we'll find out, but I think you're right. I think there's a more value proposition as we look at the prototypes we're doing is more on the post-trade side than the exchange side at this point. But yeah, but good point though, I don't disagree with you, yeah. All right, thanks for your time, much appreciated. All right.
Thank you.
Yep.